This is what you're buying. This is what you're getting. Now, I'm talking about SPACs. Right now, we have a new SPAC from the SPAC king, Chamath Palihapitiya, who has filed an S1 for American Exceptionalism Acquisition Corp. So what they're trying to do is raise $250 million in the form of 25 million shares at $10 each for a company that does nothing. So these are publicly traded shares for a shell company. The sponsor then has 18 to 24 months typically to take that cash and find a private company to buy. When that happens, the private company will be eaten by the public company, and that private company will then be traded in the public market. So essentially, it's almost like a backdoor to going public for that private business. Here's the issue though. You're basically giving up a ton in fees. So part one, you have the IPO where the underwriters, so the banks, are going to be charging somewhere in like the 3% range. So in this particular SPAC, it's 30 cents for every $10. And there's going to be the fees related to the merger. Second thing is there's something called promote. The sponsor is actually going to get 30% of the shares in that initial shell company. It is contingent on the performance of the actual business, like post-merger. The shares have to trade up 50 to 100% for say the first 1 month post-deal, which is what's actually in the documents for the sponsor to get all of those shares. So what's interesting is that the SPACs that were done in 2020 and 2021 are trading down 65 to 90%. So I would argue it's much more important to see what happens in the long term, not just the 30-day period post-merger. Most of the money that is raised is actually going to be eaten away in the form of fees. So I'll let you decide if you feel comfortable paying 35% in fees.